Hi, I'm Peter Cuff from Cuff's Chartered Accountants and Business Advisors. In this short video, we're going to talk about setting up a farm business from an accounting perspective. If you have any questions after viewing this, please feel free to give me a ring. First up, we're going to talk about structuring, and by structuring I mean we're going to set up a business. Are we going to set up as a sole trader, which is just you? Are we going to set up as a partnership, which would be you and your partner, the two of us? 2 years. Third option, a company. We could use a company structure, or we could use a trust. So I'll talk through those options. There's various reasons why we might choose what we choose. Quick run through of GST, very basic run through of GST. ACC, so I'm just going to give a wee bit of a run through ACC because that has to have some thought when you're going into business for yourself. You don't just let it happen. With ACC, you're better off to make some conscious choices about what you do with ACC. I'll give a brief run through of the taxes, and that will be fairly brief. And also, then I'll finish on what you're looking for when you're choosing an accountant. What sort of services do you need when you're trying to grow a farming business? I'll start with structure. So as I said before, we had 4 options: sole trader, partnership, company, or trust. And the first of those is the sole trader. So the sole trader is just me, if I was the farm, I'm just going to be Peter Cuff. I could use a trade name if I wanted to, but at the end of the day it's me. I'm the one that all the legal documents are in the name of, I'm the one that the invoice is in the name of, it's me. Okay. Sole traders, simple, low cost, you don't really have to do anything. You can go and start trading in your own name tomorrow. You don't have to do anything. The only thing we will have to run through is some of the other ones like GST and ACC, but we don't have to go and form any sort of organisation. Okay. The big but about just being a sole trader is we've got no opportunity to split income. And I've got an example of that, real basic, but it's probably very common in farming to show why we want to split our income. And liability is unlimited, so you're just liable for everything, every bill, which is normal. But if you run into trouble, you're the ultimate person. You're responsible for everything. If something happens to one of your employees, you're the one that gets sued. It's all of yours and all of your assets. Okay. I wanted to just show you, because in this I'm talking a little bit about income splitting, so I need to show you why we want to split income. So first off, we have a range of tax rates, right? So for individuals, we start at 10.5 cents, we go up to 17.5 cents, on to 30 when we've got more than 48,000 of income, and 70,000 plus is 33 cents. Now if you earn $70,000, all right, it's not that it all applies at 33 cents, it's only, if you earn 70,001, it's only the last $1. Right? You'll get the first 14 at 10.5 cents, you'll get the next up to 48 at 17.5, and you'll get the next 22,000 at 30. All right, so people used to think if you don't want to move up a tax bracket because you get whammed with a whole lot of extra tax. You don't, it's just on those last dollars in that bracket that you earn that get hit with that higher rate. Companies, flat rate, 28 cents on the dollar, whatever you make. And trust the 33. So you can see there's some considerations about structuring just because there's different tax rates. Individuals have one rate, companies have another, trusts have another. That leads us to make certain decisions depending on where we think our income is going in the future. Example of income splitting. Right, so if you're just trading in your own name, if you make a profit of $80,000 for the season, the tax on that is $17,000. That's how much tax you'll make. Right. If it was you and your partner working on the farm and you form a partnership and we split it equally, the tax on $40,000 each is you pay $5,500 each, which is $11,000. That's $6,000 less tax, or 36% saving. That's why we look at income splitting. That's why we're interested in structures up front from a tax planning point of view. Right, because there's big savings to get it right, and big costs if you just start out at something and go, oh, I'll fix it later. Okay, so I'll go wanted to show you why it was so important about structure. Okay. So back on partnership. So that's you just trade in your own name. You can use a trade name, but again, it's just the two of you. All right, that's who. Again, that's all who the legal documents are. It's who the invoices are in the name of this. Again, low cost. To become a partnership, at the very basic level, there's one form that takes 5 minutes to fill in and apply for a partnership number of IRD. So it's very low cost to set up a partnership. All right. If you're going in a we don't often talk. You can have partnership agreements. We don't often do them with husband and wife partners. De facto relationships. We don't often go down that way. We always have one if we're two unrelated parties going into partnership in a venture. But most family ones again are husband and wife, de facto partner type relationships. Again, there's not great flexibility in income splitting. You can see there's definitely an advantage because you've seen it in that slide before, but it's sort of fixed. It's sort of like 50-50. We can't, if it's a 50-50 farming partnership, you're both working on the farm, one of you goes and gets an inheritance, starts earning $20,000 a year of passive interest type income. We can't go, oh shoot, now this person's growing up and they're going to be in that high tax bracket, we need to change our split. All right, it's not flexible in changing that split. There is some reasons you can change it, but there's some that you can't. And a split is meant to be related to the amount of work each partner is. One of the things is the work each partner is doing. We could opt for a company. Now, with a company, you trade in the company's name. So again, if I'm going to go and do it, I could be Peter Cuff Limited. That could be my company. All right, and I could be farming in that name. It's a separate legal identity. It's not me. It is the company. And all the documents are in the company's name. All the invoices go to the company. The company is registered with IRD for the taxes and the GST. It's a completely separate legal entity to yourself. We do say that liability is limited with companies, but in a lot of practical cases, like if you borrow money from the bank, they always want a personal guarantee and whatever else they can find around. And like most suppliers have got personal guarantee sections for companies that you have to sign when you're opening an account with them. So it's not that limited these days for a lot of things. Moderate, bit more ability to split income with companies. We can just get to the end of the year and go, oh yeah, righto, the profit is 100,000. We've got two of us. What we'll do is we'll give 40,000 to this person, 40,000 to this person. We'll leave the other 20 sitting in the company and pay 28 cents in the dollar on that. All right, and so if we go back to the rates, that's the most tax effective thing we could have done if we had $100,000. Well, we can actually take up to 48 each. All right, so it depends if you've got some of our off-farm income. But the most tax effective thing is to give each person $48,000 and pay whatever balance is in the company at 28 cents. So we've got a little bit more flexibility, and we can do that. We do it all the time. IRD actually measure it. They know that there's a hell of a lot of people that earn $48,000 a year and more. And at 70, there's a big band of people that earn 70. And that's because there is a certain amount of control in depending on what structure you choose. But there's a cost to set up a company. It's not great, given a lifetime sort of thing to do a company at $600. And then from an accounting perspective, there's an extra couple of $100 a year in how we have to deal with a company's set of accounts and filing an annual return with the company's office type thing. So there's a little bit of extra cost annually. So you're doing it if you can see a potential saving. Trust. So that's often trade in the trust name. Effectively, that is the trustees are the legal entity. Whoever is appointed, the trustees of the trust. Sometimes you can set up a company to be the trustee, and already you can see I'm getting to one of my buts, and the but is sometimes they're not easy to understand. Liability can be limited. Again, that might depend on whether we've gone with a trustee company as the trustee. Ultimate and sort of flexibility of income, we can decide it doesn't matter how much work you do, we can actually, if you do nothing, we can still decide to give you $48,000 worth of income from the trust. Alright? There are some limits for children under the age of 16, but not for adults. So regardless, if you do nothing on the farm, we can still give you $48,000 worth of income and still take advantage of a 17.5 cent tax bracket. Right, so we've got quite a bit of flexibility there. There's also another but, it's actually got 33 cents worth of tax on the remainder, whereas the company only had 28 cents on the remainder if we kept it in the company. So trusts were very, very popular until the company tax rate took 2 steps down, because the company tax rate used to be 33 as well. Now with the company tax rate at 28 cents, companies are actually reasonably popular now in terms of structuring a farm. And you can also have, in the end of the day, if you want the trust set up in the way, that's how you want to deal with your whole family thing with trust, because there's some advantages for family income protection and eventually passing on income to your children. You can actually set up so that the company is owned by the trust. So there is, you can't use combinations of them, but we're getting more complex, and that's what I said, it's not easy to understand. People don't understand that with a trust, it's not actually yours. It's not your money. You hold it in trust for the people you have listed as beneficiaries. It's not yours. You can't just do what you want. What's the best structure for you then? All right. What we tend to do, contract milkers, if you're just doing contract milkers, often people start off with the simple structure. They start off with the sole trader. They might only be on their own, so that's what they'll be. Or they start off with a partnership. It's simple, it's low cost. But what makes a difference for us, it's a future. Where are you going to be? What do you plan to be in the future? If anywhere in the future you intend to own livestock, we sort of turn around and say, hey, by the time we're owning livestock, we have to be in the structure you're going to be in for life. What are you choosing for your life? We've got to make that step. So we can do 3-4 years contract milking and be in a partnership, and then you might say, listen, I'm going to go 50-50 next year. We'll probably say, right, we've got to deal with your structure. It's not suitable. The reason it's not suitable, number one, 50-50, often you make more money and you're often in that top tax bracket area. We have to look at that 28, the difference between paying 28 cents and paying 33. Right, can be a lot of money saved in that. Number two, we can't go shifting livestock around once it's owned somewhere. There's normally tax consequences of that. They've got to be shifted at market value. That can often lead to taxation. That's not what you want when you're trying to get ahead. So we've normally got to make a long-term decision before you acquire livestock. That's probably our key point. Okay. Just keeping timing going here, so I just sort of knew where I was going.
Peter, just a question.
Yeah.
If a few of the young ones here wanted to maybe buy a few livestock and then sell on, so grow a bit of equity.
Yeah.
Do you?
The sell-on's not an issue, but if you're trying to acquire a bit of livestock, lease it out, grow up your numbers to eventually go 50-50, then we're going to want to be in the structure that you want to be in for the next 10, 20, whatever years. All right? But if you're going to buy them, rear them, and sell them, you're going to get the tax when you sell them anyway, so I wouldn't be worried about that. But if we're rearing to keep them, eventually for a 50-50 position, then we need to have the right structure.
So it's more of an issue with capital stock rates than trainings.
Yes. Yes, it is. GST. People know that. All dairy farmers are registered for GST. I don't know a single one that isn't, so I don't need to go over the things about whether you need to or whether you don't. There's also no disadvantage to registering for GST in a farming situation. Right? In a farming situation, you get paid GST on top of your income. If you had a $10,000, say your production was 10,000 kgs of milk sold for the month, you get $1 a kg, you get $10,000. If you're registered for GST, you get 10,000 plus the 15% GST. So the GST is added on. You don't get it if you're not registered. You do get it if you are. It's added on. You're basically holding it to get back to IRD. All right? You're only an intermediary. You're going to pay it back to IRD. But when you go to pay it back, you also get to claim at that point, was there any expenses that you had that you paid GST on, and you can get 15% of those back. Okay. Most common ones: shed expenses, power, vehicle, fuel, livestock, and overriding there, you've got to be buying it from a GST registered person. But the majority of businesses are. There are some small, whom you can generally tell because they're just small, they do the odd job here and there, that aren't registered. If they're not registered and they don't charge you GST, you can't claim it back. Alright, same with the bank. The bank don't charge you GST on your interest, you can't claim it back. Alright, you can't claim back anything on your personal. And you can't claim back on the wages that you pay your staff because you don't give them an extra 15% and say, oh, here's a GST on top of your wages. You don't give it to them, you can't claim it back. Alright? If you're a 50-50 share milker and you happen to, I have actually had a 50-50 share milker that's also had a contract milker. And so, yes, they were paying the contract milker plus GST and claiming it back. And so that's the real basics of GST. There's a few options when we're doing the setup of your business that we have a look at. The first option is, do we register with IRD on an invoice basis or a payments basis? The difference is, invoice basis, you account for GST on the date of the invoice. So if you get an invoice dated the 31st of March, it's in the, let's say the February-March GST return, that's the one that you put that in. Alright? On the payments basis, if you had the invoice dated 31st of March and you pay it on the 20th of April as normal, right, it's in the April-May period. So one of them is based on the date of payment, one of them is based on the date of the invoice. Majority of our farmers, 95% of our clients are probably on payments basis. It's because most tracking of smaller type businesses is actually tracked through the bank account. It's tracked through the date of transactions through the bank. Alright, and people record, most farmers actually record their stuff on a cash book type system initially. Well, that's tracking as it goes through the bank, so 95% payments basis. Some really big ones are on invoice. And payments is easy to track, invoice is a bit harder. You get a choice of whether you do it 1 monthly, 2 monthly or 6 monthly. We recommend the 2 monthly. We don't recommend the 6 monthly. It just depends on size, but the issue we find with 6 monthly is by the time people get the bill, it's really big. There's 6 months worth of work to be done. They've left it for the last minute and they've got 6 months worth of recording to do for GST. 2 monthly, you get in the habit, it's every second month, there's only 2 months to do. If you did leave it till the last night, you can probably still get it done through internet banking and pay it. And it's a smaller amount. It's just easier to manage. And we just don't really opt for the 1 monthly because it just, yeah. So it just seems a bit much. Some people do it. It's a choice. If they want to say, no, I'd like to do it every month, they can. Accounting for GST. So options in terms of your accounting. Alright, so some people opt for a manual cash book. We're almost getting away, we almost don't encourage those anymore. We didn't used to mind as long as they were written up properly and balanced, but we find that, you know, maybe 9 out of 10 people can't actually balance them properly. They can't actually record, balance it, make sure it matches to the bank. You know, they do their subtotals and they transpose some figures. You can make all sorts of just little wee mistakes when you're just doing things manually. You can use an Excel spreadsheet, which will take rid of the counting up problems, but we still find that people, you know, they might get something and they forget to analyze it, put it into a certain column, and things just don't work. If you go to a computer program, that doesn't happen. The computer doesn't let you, all right? And the computer never makes a mistake totaling up. Things just work. All right. Normally, the computer programs are trained, and they know that you can't claim on your wages, you can't claim on your bank fees, but you can claim on your fuel. All right. So they're normally set up, well, they're always set up because, like, normally your accountant will set them up for you. All right. And they'll do the GST returns as part of that. So you can do that with programs you install on your computer, like MYOB Cashbook, Cash Manager Rural, other options via the accountants. Virtually probably all the accountants on the coast use a program called BankLink, which gives us electronic imprints of your bank statements. And we can either give you a copy of BankLink and you can do the work yourself, or we can do the work. Either way, we swap data, and it's really good because we know where you're at. The other ones, we don't know where you're at unless you bring it in and show us. But by us with BankLink, we can actually look and see where you're at. We can do a tax review because we know where you're at. Just makes it a lot easier for us to get the data. And same with online. So online programs, MYOB Live Account, Xero, Cash Manager Rural Online. They're all online now, providing you've got a reasonable broadband level. It doesn't have to be anything flash. As long as you've got a broadband connection, you can do them using the online packages. They're really good because normally you can share them with your accountant, you can share them with your bank if you wanted to, but you can actually allow people access to those so that they can actually come in and look. We use it all the time to just go and review and make corrections for people. I've got someone in my office at the moment, we've just put him on a 3-month thing. Every 3 months we'll whip in, have a look at his Xero data and let him know where he's at and whether there's any faults in his data, but also tell him how his business is going. Because it's all one thing for the computer program to say, but some people don't. They can be a bit hard to understand. Sometimes you need some help. ACC. If anyone's ever had any dealings with them, they're the worst government department I've come across. They are absolutely inept. Their systems are failing all over the place, and I had a client the other day that paid, I was looking at their cash flow for the 2 months, and I went, why have they paid, they paid 10 grand ACC in a year? That's way too much. Go back looking in, they'd overpaid at 7 grand because they got a bill from ACC, but the bill had a credit on the other page, and they paid the front page. And it's just the way ACC structure it, it's hard to understand. ACC levies, unfortunately, there's no way out. It's basically a tax and you've just got to get used to it. You have to pay ACC. There's 4 components just to make it difficult. ACC is broken into 4 different components. And they invoice some of them at different times, just to confuse you. There is the work levy, which is for your work injuries. All right, that could be for you, it could be for your staff. If you're employing staff, you'll get a bill for you and you'll get a bill for your staff. All right. The earners levy, that's for non-work injuries. All right. You don't get that for your staff pay it in the PAYE. So if you've got staff, you won't get that bill. But if you are the staff, you're also the employer and the employee, or it's just you in partnership, you get that piece because you also have non-work accidents. So if you're in a partnership or a sole trader, you're going to get that piece as well for yourself. Or even if you're in a company, you're going to get that piece for the amount of income that is for you. There is a residual levy to do with pre-1999 claims when they changed the whole system. I'm not going to go into why, but there's another 38 cents every $100. And there's now a workstation levy. The last 2 they invoice at a different time from the first 2, so you get 2 bills. You'll also get a bill of partnership. You get one for you, one for your wife. If you're employing at the same time, you get one for you, one for your wife, and one for your employees. Twice. And you'll probably get 2 of them in a year each. Anyway, the main thing is about the $3.79. So if you earn $100,000 in a year, make it really easy, that's $3,790 of levies in a year that you're going to pay. All right. If you've got employees, it's, you're at the $2.07 plus the 38. I think so you're about $2.40 or something like that. So 100,000 of wages, 2,400 of levies for your employees. They're the farm rates there. Now with ACC, we have a number of options. There's a do nothing option, which we don't recommend. The do nothing option, you just get to the end of the year, your tax return's done, IRD, tell ACC what you earned, ACC send you the bill. All right. There's an issue with that if you're first going out contract milking, share milking. The issue is ACC don't know what you're actually earning if you're injured in that time. So they give you the minimum amount, which is based on 28 $1,600 a year, it works out to be $379 a week in the hand. Right? It's not enough for you to pay somebody to replace the work that you were doing. Right? So you don't really want to get caught on that. And you've got to prove you've lost earnings. Well, if you're in a husband and wife partnership, sometimes that's hard to prove because the wife's, if you're the husband, you've gone and injured yourself in rugby, the wife sometimes ends up picking up all the slack. You've got to, how do you prove the loss of earnings? You might have had none. So you pay all the levies, but you won't get any compensation. So for farmers, we recommend the Cover Plus Extra option. And that is, you deal with that up front. You nominate a level of cover. We often go for around about $48,000 a year. We do differentiate it between the parties if one of them's working more than the other. But we really look at what's it going to cost you to replace the labour. If something happens to you and you can't work, what's it going to cost to replace and put someone else in doing that work? And that's often where we see the levy. Right? If you're totally opposed to ACC in any form, you can nominate to pay the lowest on the minimum, and that's all the compensation you'll receive. So you can control with that. You do pay the levy up front. You get, if you're injured, you get paid out based on your nominated level of cover, what you've already agreed. You don't have to prove loss of earnings. You only have to have the doctor say you can't work. And so we think it actually works better in a farming environment, much better than just doing nothing and letting the bill arrive out of the blue one day from ACC. You can actually go and get some workplace safety discounts. You can get a 10% reduction if you can prove to ACC that you have the health and safety systems in your business. You go through a self-assessment thing first, and then they'll send an ACC auditor to come out or an ACC approved auditor to come out and confirm. If they agree, you'll then get a 10% discount for the next 3 years. All right, but if you've got the systems anyway, then you want to have a look at that. Help on that way, because we know lots of people haven't got what they should have in health and safety and stuff on the farms. We've organised a course with ACC, and that's coming up on the 22nd of July in Cockdye and the 23rd of July in Harry. That will do ACC, do income tax. Right, income tax, first year. So I've given us a first year and a second year I've broken it into. The first year, we don't know what you've earned. You don't know what you've earned until you get to the end of the year and you calculate it. All right? So the first year there actually isn't any tax. That's what they say sometimes about the first year. There's no tax. So if our first year is say the 14-15 season, let's say we're off contract milking this year, 14-15 is our first season, we won't pay the tax on that season until April of 2016. That's 2 years after you started that season, basically. So we've got to do some planning around taxes. We can't just say, oh great, no tax the first year, because what happens the second year is we end up on provisional tax. Alright, and we also end up with the tax from the first year coming through in April 16. So we end up with 2 years worth of taxes. We have a year free, but then we end up with 2 years. If we don't plan for that, we see some serious trouble around the time that the tax comes to pay, as Stephen said in his no surprises type. So in your second year, your provisional tax is based on 105% of your last year's tax. That's the standard calculation. We can do some stuff around to make it different, but generally that's what it is. Alright, it's paid in 3 instalments. If you're a May balance date, that's what most dairy farming type organisations use, 31 May. Then it will be due 1/3 of 28th of October, 1/3 28th of February, and 1/3 of 28th of June. So, if you're in a partnership and you make the 80,000 that we had an example of earlier, we complete your financial statements, say by August 15 for our 14-15 season. Your terminal tax, that's what we refer to as your end of year tax for that year. For the 14-15 season, $5,500 each will be due 7th of April 16. and then would start paying provisional tax. Well, we'll start paying before that actually, as soon as we've done the calculations. Our next year's provisional tax, the first instalment, that is $1,925. That's each, by the way. I didn't put that there. But that will be $1,925 each due in October, then in February, then in June. Now you can see there. Just what we want to write. You can see here. Look at the amounts that are coming up. This one here is in Feb. This is in June, and that's in April. All the same year. You can see there's an awful lot of tax inside of about 4 months. Alright, and so that's part of what you should be doing when you start a contract booking. You should be saying, right, how much do I need to set aside for tax? You can set it aside in a bank account. You can set it aside and give it to IRD. I flipped over quickly before I didn't talk about it, but you can get a discount if it's your first year in business and you voluntarily pay some. They will give you a discount to reflect that. So you can actually pay it to IRD. But the idea is not to have that 2 years worth of tax. Think, whoa, everything's good in your first year because there's no tax bills and everything's looking great, and you spend it. Yep, you buy the new you. Right? Second year, things turn custard because you get 2 years worth of bills of tax. Alright? So it's a planning thing. We like to plan our taxes. Right, on to choosing an accountant. What you should be looking for in terms of a farm accountant. Right, so you want someone that's going to help you do your financial goal setting and related long-term budgets. Too many people in contract milking and share milking get tied up in the tractors and the depreciating assets. If you don't have the plan about how you're going to move from contract milker to share milker and have $2,000 a cow, it's a big investment. If you don't have that plan and you start putting it into things you don't need at that time, you won't get there. So you want someone that's actually going to help you set a plan. You want to do yearly budgets. You want to know where you are, because otherwise, you'll go and spend off on things that you didn't need to, and it'll take you off track on the plan. Dairy-based farm benchmarking. That's a good thing to get into longer term. Sometimes we'll actually manage to get the farm owner to do it with contract milkers, and we'll combine the figures and we'll be able to look at the farm as a whole. You want to do tax, you want your accountant to do tax reviews. You just don't want you to bring in the accountant at the end of the year and they produce a thing and they give you the shock of your life and they tell you what your tax bill is. Alright? You want to actually get them doing tax reviews as you go through and give you indications of where your tax is going, because sometimes you can do things to change what your tax is. Depends on your circumstances, sometimes you can. Accounting software support. So you want someone that's actually going to be able to say, recommend, install software for you and support it. Alright. ACC management, I think because of we're starting to put more and more of our clients now into, like, we'll just manage the ACC for them. The bills come to us, we check them, because ACC often, they either forget to bill people, they bill in the wrong amount, and people are so, don't understand ACC to the extent that they just pay the bill. And I think ACC have even got a stat that says something like 75% overpaying or paying the incorrect amount of ACC. You want to be able to report whatever system you use. You want to be able to report actual versus budget. So you need to actually know, right, this is where I was budgeted to be, this is where I am, I've overspent in this area. But you might say, but I've underdone in this, or I've got this extra income because I feed the cows more, and it's come out more on my production or income side. Seminars and training. So again, look for an accountant that's actually running and doing seminars in the farming sort of sector. It's a very cheap way of gaining knowledge as opposed to going in and sitting in front of an accountant and getting it all direct. Just make sure you're choosing someone that's actually got a lot of farmers, that they are actually a farm accountant as opposed to, well, an accountant who just happens to have some farmers. Check out their website. Have a look around, see how much they do that's farm related. On farm service plans. So some of them will have plans that say, right, you can, this is what we'll do and this will be what the cost is, and you can select what plan you want to be on. That's good because you know upfront what your cost is, you can pay it monthly, and you know what you're getting. On-farm visits, again, look for an accountant that will go out and see you on farm. It's actually quite important to actually see on farm because you actually get to understand where people are at by getting out on the farm as opposed to them coming into your office. And I don't think that doesn't really matter when you're the contract worker on the farm. Or the 50-50 or the owner. And look and see if they'll, whenever you're checking out, say, will they do a free initial interview? We always sit down for an hour with new people free of charge and give them a lot of the information we've gone through today, but particularly a circumstance, obviously. Where else have I got to go?